Imagine you are sitting at your kitchen table on a Sunday morning. You are doing what I like to call a financial deep clean. You look into your wallet and see that dusty old piece of plastic you got back when you were in college. It has a zero balance, a clunky rewards program that barely earns you a cup of coffee once a year, and you have not swiped it in 18 months. You think to yourself that closing this account is just good housekeeping. It is one less login to remember, one less card to worry about losing, and it feels like a step toward a simpler life. You pick up the phone, call the bank, and say those 4 words that feel so productive. I want to cancel. But here is the problem. While you feel more organized, the algorithm at Fair Isaac Corporation, the people who build your FICO score, is already beginning to deduct points from your financial future. You did not just close a card, you mathematically volunteered to pay more for your next mortgage, your next car loan, and even your next insurance policy. Most people think they are just losing a bit of history. They think the damage is minor. They are wrong. It is a calculated error that can haunt your credit report for a full decade. Before we dive into the specific math of why that college card is your most valuable financial asset, I want to make a deal with you. The next 20 minutes might be the highest return on investment you get all week. We are going to look at the gears and levers inside your credit score that lenders never explain to you. If you find this level of deep dive analysis useful, I would love for you to join our community here. We call ourselves the Optimizers. If you click that join button, you get priority in the comments and some custom badges for the channel. It is how we keep the lights on and the data coming. Now, to understand why closing that card is such a disaster, we have to look at the FICO formula. This is not a guessing game. It is a weighted system where 90% of top lenders use the same playbook. When you cancel that card, you are not just hitting one category of your score. You are actually destabilizing 45% of the total calculation. We are talking about 2 massive weights: your credit utilization and your length of history. Let us break down how the math actually works when that account disappears. I have spent a lot of time looking at the FICO model, and it helps to think of your credit score like a 5-layer cake. The bottom layer is the biggest, 35% for payment history. Basically, do you pay your bills? Easy enough. But the next 2 layers are where the cancellation error happens. Amounts owed makes up 30%, and length of credit history makes up 15%. Together, those 2 categories control nearly half of your financial reputation. When people talk about their credit score, they usually focus on the 35%, the payment history. But that is reactive. It only tracks what you have already done. The 30% and the 15% are structural. They represent the current architecture of your financial life. When you close your oldest card, you are essentially taking a sledgehammer to the foundation of those 2 structural layers. The FICO Score 8 model, which is the industry standard right now, is particularly sensitive to these shifts. It looks for stability and available capacity. A closed account signals the opposite of stability to an algorithm. It looks like a reduction in your financial footprint. To the computer in a dark room at FICO headquarters, you did not just tidy up your wallet, you effectively shrank your creditworthiness. Let us look at why the first hit happens the very second that card issuer sends a report to the bureaus. Let us talk about the 30% category, amounts owed. This is a bit of a misnomer because the algorithm cares less about the dollar amount and more about the ratio. This is your credit utilization. It is a very simple division problem, your total balances divided by your total limits. This is where most people make their first mathematical error when cancelling a card. They think if they have a 0 balance on that old card, closing it should not matter. But they are forgetting the denominator. Your total available credit is the sum of every limit on every card you own. If you have 3 cards and you close one, your total available credit drops. This might not seem like a big deal if you do not carry much debt, but the math says otherwise. The Consumer Financial Protection Bureau and major bureaus like Experian tell us to keep this ratio below 30%. But if you want to score over 800, you really need that number below 10%. When you remove a limit, especially an old one that has probably grown over the years through credit limit increases, you are making your denominator smaller. This means any balance you do carry on your other cards now represents a much larger percentage of your total credit. You could wake up the next morning with a doubled utilization rate without spending an extra penny on a single latte. That is the immediate mathematical penalty. Wait until you see how this plays out in a real-world scenario, because the numbers are startling. Let us look at a consumer I will call Alex. Alex has 3 cards. Card A is the oldest, 10 years old, with a $10,000 limit and a 0 balance. Card B is 5 years old, with a $5,000 limit and a $2,000 balance. Card C is 2 years old, with another $5,000 limit and a $3,000 balance. Right now, Alex has $20,000 in total credit and $5,000 in total debt. That is a 25% utilization rate. Alex is doing fine. He is under that 30% threshold. But then, Alex decides to tidy up. He closes card A because he never uses it. Suddenly, his total available credit is not $20,000 anymore. It is $10,000. His $5,000 debt did not go away, but now it is being measured against a much smaller pool. Overnight, Alex went from 25% utilization to 50% utilization. In the eyes of the FICO algorithm, Alex just became twice as risky. He did not lose his job, he did not miss a payment, and he did not spend more money. He just performed a mathematical self-sabotage. For someone in Alex's position, this single move could trigger a 40-point drop in his credit score within 30 days. That is the difference between getting a prime interest rate and being bumped into a much more expensive tier. Now, let us move to the 15% category, length of credit history. This is where the most common myth in personal finance lives. I hear people say all the time that if you close your oldest card today, your credit age drops to 0 immediately. I am here to tell you that is actually a myth, but the reality is much more dangerous because it is a ticking time bomb. Under the FICO model, which again is what most lenders actually use, an account closed in good standing does not just vanish. It stays on your report and continues to age for exactly 10 years from the date of closure. So, if you close that 10-year-old card today, FICO still counts it as a 10-year-old card tomorrow. You might be thinking, Tom, if it stays for 10 years, why does everyone say it is a mistake? The reason is twofold. First, you are losing the anchor of your credit profile. Second, there is a massive difference between how FICO sees your history and how those free credit monitoring apps see it. If you are checking your score on a site that uses VantageScore, you will see a drop immediately because they often exclude closed accounts right away. But with FICO, the real pain is delayed. You are setting a trap for your future self that will spring in exactly 1 decade. If you think a 40-point drop from utilization is bad, wait until you see what happens at the 10-year mark. We call this the 10-year cliff. Let us run those numbers. Imagine your current average age of accounts is 7 years. That is considered a healthy, solid number. Your oldest card is 15 years old. If you close it today, it stays on your report for 10 years. Fast forward a decade. You have been responsible. You have opened a couple of new cards over the years, and your credit feels great. But on the anniversary of that closure, that old 15-year-old account, which would have been 25 years old by now, gets purged from your report. Suddenly, your average age of accounts does not just dip, it craters. Because you closed it 10 years ago, it stopped being an active anchor. When it falls off, your average age might drop from 12 years down to 6 years in a single day. You have effectively robbed your future self of years of credit seasoning. It is like planting a tree and then cutting it down right before it starts providing real shade. This is why keeping that oldest line open is about long-term strategy. It is the only way to ensure that as you open new accounts in the future, your average age stays high enough to absorb the impact. Without that old anchor, every new card you get will drag your score down much further and much faster. This leads us to what I call the anchor effect. Think of your oldest credit card as the lead weight on a fishing line. Every time you open a new account, whether it is a car loan, a mortgage, or a new rewards card, you are adding a 0-year-old account to your average. If your oldest card is only 3 years old, a new account is going to pull your average down significantly. But if your oldest card is 20 years old, that heavy weight keeps the average from moving too much. It stabilizes your score against the volatility of new credit. Most people stop their analysis at the immediate score drop, but they miss the opportunity cost. By closing that old card, you are making it harder for yourself to take advantage of new financial opportunities later. Want to open a new travel card to get a massive sign-up bonus? If you closed your old Anchor card, that new application is going to hit your score twice as hard. You have essentially removed the shock absorbers from your credit report. This is where the math of the 15% history category meets the math of the 10% new credit category. You are making your entire profile more fragile. In the language of risk analysis, closing that card is an action with 0% upside and 100% downside for your score. But, as I always say, personal finance is not played out on a calculator alone. This is the part where conventional wisdom says you should never, ever close the card. But I am going to tell you that sometimes you absolutely should. Financial literacy requires nuance, and there are 3 specific scenarios where closing your oldest card is actually the smart move, even if the math says otherwise. The first is predatory annual fees. Many people start their credit journey with what we call subprime lenders, companies that target people with no credit or bad credit. These cards often come with monthly maintenance fees or high annual fees that offer 0 rewards. If your oldest card is charging you $10 a month just to exist, that is $120 a year. Over a decade, you are paying over $1,000 just to prop up a credit score. No 5 or 10-point boost is worth $1,000 of unrecoverable cash. In that case, the fee is a leak in your boat that needs to be plugged. The second scenario is psychological. If having that open credit line represents a temptation that leads you into high-interest debt, the math of your credit score no longer matters. Paying 24% interest on a balance is a much bigger financial disaster than a temporary dip in your FICO score. Your mental health and your ability to stay out of debt are worth more than any algorithm's opinion of you. Finally, there is the legal necessity of joint accounts. If that old card is tied to an ex-spouse, you need to sever that tie immediately. The risk of them maxing out the card and ruining your credit is far higher than the risk of you closing it yourself. But what if you could have the best of both worlds? What if you could stop paying that annual fee without killing your oldest credit line? There is a strategy that the big banks do not exactly advertise, but it is one of the most powerful tools in your financial toolkit. It is called a product change. Instead of cancelling the card, you call the issuer, Chase, Amex, Citi, whoever it is, and you ask to downgrade the account to a no annual fee version. This is the mathematical equivalent of a cheat code. When you do a product change, the bank typically keeps your existing credit limit, which protects your 30% utilization score. But even better, they keep the same trade line open on your credit report. That means your 10-year-old account stays a 10-year-old account. It just has a different name and a different piece of plastic in your wallet. You have effectively stopped the bleeding of the annual fee while keeping your credit history and your utilization denominator perfectly intact. I've done this myself with cards I no longer found useful. It takes 5 minutes on the phone and it saves your score from that 10-year cliff we talked about earlier. This is how the optimizers handle their credit. We do not just accept the choices the bank gives us. We look for the path that keeps our math working for us instead of against us. Once you have successfully downgraded that card, or decided to keep it, you cannot just cut it up and forget about it. This is a common mistake that leads to what I call the involuntary cancellation. Credit card issuers are businesses, and they do not like keeping inactive accounts on their books. If you do not use a card for 12 to 24 months, the bank will often close it for you due to inactivity. If they close it, you suffer all the mathematical penalties we have been discussing, but you lose the control over when it happens. To prevent this, you need the sock drawer protocol. You take that old card and you tie one small, recurring monthly charge to it. I am talking about something tiny, a $3 iCloud storage fee, a Spotify subscription, or even a small recurring donation. Then, and this is the vital part, you set that card to autopay the full statement balance every single month from your checking account. Once that is done, the card is technically active in the eyes of the bank. They see activity, they see on-time payments, and they keep the line open. You can literally put the physical card in a sock drawer or even destroy it if you are worried about fraud. The digital record, the trade line, stays alive. This ensures that your oldest account continues to age, your utilization denominator stays high, and you never pay a cent in interest. It is a set-it-and-forget-it strategy for an elite credit score. Before we wrap up, we need to address why you might see conflicting information about this online. There is a reason your friend might tell you their score didn't drop at all when they closed a card. It comes down to the battle between FICO and VantageScore. Most of the apps you use for free credit monitoring use VantageScore 3.0. This model is much more aggressive. If you close a card, VantageScore often stops counting it in your age calculation immediately. This is why people check their app a week after closing a card and see a massive drop. They panic and assume their FICO score did the same thing. But remember, FICO is the one that lenders actually use for mortgages and car loans. FICO is the one that gives you that 10-year grace period. It is important to know which scoreboard you are looking at. If you are preparing to buy a home in the next 2 years, do not make any moves based on what a free app tells you. Look at the FICO math. Understanding the difference between these two models is what separates casual observers from people who actually master their finances. You have to know which rules the person on the other side of the desk is playing by. And in the world of high-stakes lending, FICO is still the king. So, what is the final verdict? Closing your oldest credit card is, in almost every case, a profound mathematical error. You are volunteering to shrink your credit capacity, which spikes your utilization. You are setting a countdown for your average age of accounts to crater a decade from now. And you are removing the anchor that protects your score from the impact of new credit. Unless you are being charged an exorbitant fee that you cannot negotiate, or you are protecting yourself from the psychological trap of overspending, that card is worth more to you open than closed. Credit scoring is not an emotional process. The algorithm does not care that you want a clean wallet. It only cares about the data points. By keeping that old account active with a tiny recurring charge and autopay, you are making the algorithm work for you. You are building a history that will eventually span decades, making you look like the most stable, reliable borrower in the world. That stability translates into lower interest rates, which translates into thousands of dollars kept in your pocket over your lifetime. It is a simple game of arithmetic, and now you know how to win it. It is about playing the long game in a world that is obsessed with the short term. Your future self will thank you for the Sunday morning you decided not to cancel that dusty old card. I want to hear from you now. Have you ever closed an old account and watched your score react? Or maybe you have successfully pulled off a product change with a bank that tried to tell you it was not possible. Drop a comment below. I treat these comments as a form of peer review and data gathering for our community. We learn more when we share our actual experiences with these banks. If you found this breakdown helpful, consider hitting that join button to become an optimizer. It is the best way to support the deep dive research we do here, and it helps me keep these videos free of sponsored fluff that doesn't actually help your bottom line. I have put a lot of work into the sources for this video, and everything we discussed is backed by the latest FICO and regulatory data. Managing your money is a series of small, calculated decisions, and you just made a great one by finishing this video. I am Tom, and this is Tom Talks Money. I will see you in the next one, where we are going to look at another piece of conventional wisdom that might be costing you more than you think. Keep those anchors heavy and those utilization rates light. I will see you then.